Let's get to that busy trading day now with Joe Tigay of Equity Armor Investments. Joe, GDP is coming in, the Fed's favorite inflation indicator, PCE prices, the VIX is edging up, and the 10-year now at the highest level since 2007. Should investors brace themselves?
Hi, Angie. Thank you for having me. Yeah, it's been a volatile week to say the least. We've seen maybe some choppy action and really the return of volatility, which doesn't come to us as a huge surprise. Remember, the end of September is seasonally a very weak time, so we expect to see some volatility end of September, early October, and that's what we're getting. And there are certainly some catalysts, as you mentioned. Next week, we will have a jobs report that will also be something that will move the market. And these interest rates, they're fascinating to me. You talked about the 10-year really having a tremendous run the past week, up to 4.5. The 2 years also something, a level of concern. It's at 5.1%. Now that has been an area of resistance. It's actually a little bit softer than the 10-year's been lately. And that's seeing that curve, that steepening, or the inversion of the curve. It's kind of unwinding a little bit here, which is another thing to think about in the background. We all know the 210 curve, when it's inverted, it is a prelude to a recession, but that recession never comes until that inversion reverts to its normal shape. So we're on that we're on the path towards that normal shape. At least we have been in a strong way in the last week and a half.
What do you think about picking up some of the beaten down Dow stocks, the dogs of the Dow?
Yeah, I mean, that's been an interesting spot. Last week I mentioned people are looking at these value stocks, people are looking at these dividend stocks, but keep in mind the risk is when these treasuries yields peak, and they will at some point when the economy slows down. Are you really going to want to own these dividend-paying stocks when bonds are going to be on the rise again, when yields are earning so much, when CDs are over 5%? Would you be looking at the S&P 500 dividend at a little less than 3%? Is that very attractive to you? So for me, I'd be looking at that and saying, hey, the utilities of the world, the healthcares of the world, the dividend payers of the world, they're not going to be my cup of tea with interest rates falling. Maybe as long as the economy is good enough, maybe the big cap tech is still the place to be.
Thank you, Joe.
Thanks for having me.
Go to businessfirstam.com for where to see our show on TV.